Hello and welcome to the Fund Your Retirement podcast. Today's guest is Roland Head. Roland has been investing since 2007 and is an experienced investment writer and analyst with a particular focus on UK equity income. He has been writing for Stockopedia since 2015, regularly contributes to the Investors Champion and the Motley Fool, as well as many other well-known investor websites. Roland is here to talk about his investment approach and some of the lessons he has learned over the many years as a private investor, and shares one of his strongest convictions he has in his portfolio. Hello, Roland. Thank you very much for coming on the show. Really appreciate you joining us today.
Hi, Lee. It's great to be here. Thanks for having me on.
What was the initial catalyst for your investing journey? What got you started on the road that you're now on?
My background is in engineering and IT, and I would say I didn't originally have any interest in finance at all. In my early 20s, I would say I was probably quite cynical about the whole thing. I think while I'd been growing up, there'd been scandals about personal pensions that didn't really deliver what they promised, and dodgy saving plans and things like this. So I was probably a bit skeptical about it all, but naively, my first permanent job, when I could have had an employer pension, I only signed up for the minimum amount. So I was turning away free money, which I would never suggest to anyone. Employee contributions are free money. But as time went by, though, I suppose I started to think about things a bit differently, and I got interested in the idea that I could look after my own interests and maybe make some money with my own efforts. Around the same time as that, what was a big catalyst is that I also became self-employed. And so then I realized that I actually really was responsible for my finances in the future if I ever wanted to be able to retire. So it all came together, and I found that I enjoyed understanding how the stock market worked and understanding accounts and starting to analyze things. So it became a hobby and something that I felt was useful to support my future self as well. And I think the other big thing is that I started investing actively around the financial crisis, kind of 2008, 2009. So it was an interesting time. There was a lot going on and a lot of opportunity for successes, and also for some beginners' mistakes, which I made a few of. So it all came together around then.
So 2008 was approximately the trigger then, was it? That was the wake-up call, was it?
Yeah, I think it was all the extra coverage in the news and the extra things people were talking about, and things that were quite interesting to learn, to understand what had happened, and that really built on my interest a bit.
Yeah, brilliant. So how would you describe your investing style and strategy then? So what is it you look for?
What I look for today, I would say I was a dividend investor. So I look to buy shares that will provide me with a reliable cash income without me having to sell them. That's the goal. So that over time, I'll effectively own a slice of a company or of a portfolio of companies, and that will collectively pay me out a rising cash income each year. That's the goal. So I look for companies that I think have above average kind of qualities like profitability, and that they generate plenty of spare cash each year, so that they're in a good position to provide income for their owners. And so I'm all about the income. That's the main focus of what I look for.
So dividend income is a major priority for you then when you're looking for a stock to purchase then?
Yeah, it's not just about high yield, although I'd like to have some high yield shares, but it's also about finding companies that can deliver growth in the dividend over time. So that the last year has obviously been a pretty painful example of how inflation can affect the value of a fixed income. And when I'm looking for 10, 20 years in the future, something that's attractive now might be worth a lot less at that time. So I'm looking for businesses I think have the ability just to continue gradually getting bigger and more valuable over the years, and hopefully reflecting that in the dividend that they pay out.
Just for the newer listeners to the audience, or those that are maybe not quite sure what dividends actually are and why to you they are important, can you explain to the audience what dividends are and why are they important to you when you're constructing your portfolio?
Sure. So a dividend is the portion of a company's profits that is distributed to its shareholders. So obviously at the end of a year, the company's expenses have been paid, taxes have been paid, and salaries, wages, and they'll hopefully, with a profitable business, you'll be left with a portion of earnings that aren't needed for anything immediately. One option with that cash is to return some of it to the owners of the company, the shareholders, and that's what a dividend is. That portion of profits that the company decides they don't need it for the future, they can afford to pay it out to shareholders. It's perfectly possible to invest in shares that don't pay dividends and still make good money. But to me, it's important because the dividend is evidence that a company has that profitability. It has a kind of long-term sustainable focus and that it actually does generate surplus cash from its operations. Accounting profits are great, but they don't always convert reliably into actual surplus cash at the end of the year. So a dividend is a share of a company's profits, and I see it as a very important measure of that the company has the qualities I'm looking for in a long-term investment.
Okay, so dividends clearly are very important, which, yeah, I can definitely understand why. What other things are important to you when you're looking for a company to purchase? What other metrics do you screen for?
I suppose, in a word, what I'm looking for in a company, signs of quality, financial quality, and also a broader picture of long-term sustainability. One thing I look for is a record of growth over time. I'm not necessarily looking for something that's exploding and going through the roof, doubling its profits every year, because as a general rule, that kind of thing is too good to last. So what I'm looking for really is growth, profitability, and cash generation. And from what I've learned or what I've come to believe and seen over the years is that these things together give me a good chance of generating a result that would be better than just putting all my money into an index tracking fund that just followed the wider market. I suppose to get a different result from the market as a whole, then you need something that is different to the wider market.
And I guess in time, you mentioned for the next, earlier on, you mentioned 20 years' time. Am I right in thinking that you will look to live off this portfolio with the dividend cash income from that? Or will that
Yeah.
provide a large proportion of your income in retirement? Am I right in thinking?
That's certainly my main goal. My share portfolio would account for the kind of the entirety of my pension and long-term savings. In an ideal world, I'd reach a point where I can live from the dividend income and I won't have to sell any shares, but I'm quite open to the idea that depending on how everything pans out and timescales, that I will gradually also sell parts of the portfolio over the years, as well as withdrawing the dividends. At the moment, I suppose I feel that I don't need to consider that in too much depth. My main goal is just to reinvest all the dividends I receive now and to accumulate, hopefully, for the future.
Yeah, so that's important there. You've mentioned there you're reinvesting the dividends. You should explain to the audience why you reinvest the dividends.
Sure, absolutely. Yeah, that can be a big source of growth because a certain amount of cash that's paid into my portfolio each year. Instead of withdrawing that, what I do is use that to buy more shares in the companies I own, usually additional shares in companies I already own, using my dividends effectively to buy more dividends in the future. So over long periods of time, over sort of 10 years plus, that reinvestment can make a very big difference mathematically to the long-term returns that you're effectively buying more future earnings with your current earnings. So it's a patient approach, but over, say, 10 years plus, then it makes a big difference when you compare the results to withdrawing that money each year.
Yeah, you mentioned earlier about the company pension and maxing out the company contributions. This has got similarities, hasn't it, with the dividends?
Yeah, it's very much it's a similar thing, really. Company contributions to a pension are quite literally free money if you're an employee, because you can't have it any other way. You either get it into your pension or you don't have it at all.
Yeah.
But this is not quite the same. But certainly the long-term benefit is going to give you that boost further down the line.
Yeah.
It's a case of looking to the future and trusting that it will arrive if you're patient.
Yeah, patience is the key there. And that after speaking to many experienced investors like yourself, and we just recently had Lord Lee of Trafford on, and he was all about patience. Yeah, it's a common theme that keeps coming up. Is it just solely UK stocks, or do you look for international stocks?
I only invest in UK stocks, not because there aren't good companies elsewhere, but just because I think there are a couple of advantages to sticking to one market. I think the first thing is that in addition to knowing about the companies I own, over the years, I've built up a much broader general knowledge of the culture and the rules of the UK stock market, how it works, how the accounting works, and so on. And then also there's just a question of time. In general, by the time I actually buy shares in a company, I'll have followed it in the background for a number of years. I'll probably also be familiar with some of the rivals that it operates against in the same sector and in the wider context. And although I buy stocks in quite a systematic way, I think having that kind of background general knowledge and context really helps me to make better informed decisions. I'd be perfectly happy owning probably many European or US stocks. There are lots of good companies out there, but I just don't have the time to become that familiar with those markets. And as I say, I think having that background understanding has helped me to add value to my decisions.
Makes sense. You've got your niche, you've got your experience, you're focusing on what you know and sticking with that. So do you have a specific example there that you could share with the audience of a company that you've bought your journey to that decision, why you bought it and why you've got a strong conviction on it?
I think one company, I think that captures most of what I'm looking for in a business, or I believe it captures most of what I'm looking for, is a company called Clarksons, which is it's a FTSE 250 business. So it's a mid-sized business. I think the market cap is just under 1 billion. And it's a shipping services group. So it's one of the world's largest shipping brokers that handles matching people who want to put cargo on ships with people who own ships, people who want to buy and sell them. And it has been in business for over about 170 years. So
Wow.
it's very well established. One thing that tells me straight up is that although obviously shipping is a notoriously cyclical business, boom and bust, and also exposed to commodity cycles in things like mining and oil and so on, where demand and prices can go up and down. Obviously, Clarkson's been through over 150 years.
Yeah.
It's been through major wars. It's been through lots of economic turmoil. And the company clearly has a longevity that suggests to me that they do know how to operate profitably through cycles and over very long periods. So that's attractive to me. And I think another thing I like about it is the size of the business. They've also developed a very substantial data business, which I think is something they've been doing since books were printed out and posted to you each year. But obviously now it's become a far more high-tech operation. And that's the business. And in financial terms, one of the things that attracted it to me was that Clarkson's dividend has increased continually for the last 30 years without being cut.
Well, that's interesting,
Which
isn't
it may be longer, actually. 30 years is as far back as I could go with the data I could find. So that kind of single thing in itself, I suppose, highlights the kind of sustainability and long-term gradual growth that I look for when I'm trying to find shares that I won't need to sell for a very long time. That's my goal. So it's got a good scale in its market. It's one of the largest players in that sector. Obviously has vast experience and kind of embedded experience within the business of how the whole industry works and contacts throughout the world. Financially, it's quite a profitable business, generates plenty of cash. It doesn't operate with much debt. The whole package, I think, is quite a good quality, and it's actually something I've been buying fairly recently because I believe, at least I hope, that the valuation has come down to a level that should work for me over time.
I mean, there's quite a few things I'd like to unpack there. First of all, 170 years, that's really interesting. And it's been paying dividends for the last 30 years as well and continually rising, which signals good dividend growth.
Yeah, it's announced. There's a pretty impressive record. I think there's not that many other companies on the UK market today.
Yeah, I can certainly see why that's an important one in your portfolio. How do you find these types of companies then? How do you come across these companies? Because I suspect that most of the UK population has probably never heard of that company before. But yeah, what a fantastic company it is to invest in.
Yeah, and that's true. And in fairness, I would never have heard of it if I wasn't an investor either, and if I wasn't looking for it. Yeah, certainly there are too many companies to know much about all of them. I think the London Stock Exchange has more than 2,000 companies trading on it today, shares that anyone can go and buy and sell. These days, investors have so much data and technology available to them that even, say, 20 years ago wasn't available, and it's all quite affordable, really. So what I do is mechanically strip out as many businesses as possible from the market to leave me with a smaller set that maybe match the quality dividend profile that I'm looking for. So what I do, I use the screening system that filters out companies or stocks that don't meet some basic criteria I look for. So for example, companies that don't have any track record of dividend payments, that don't pay at all, companies that are too small, and companies that aren't profitable, I suppose. Those would be the key things I'm not interested in as a start. Once I've got that shortened list, which is something like maybe 250 at the moment, so I've already got it down from over 2,000 to about 250. Then I download more detailed financial data about all of those companies and load it into a spreadsheet, which scores each company and ranks them on a number of more detailed criteria. So far, that's quite a mechanical process, and I do that just because it saves a huge amount of time. It makes an unmanageable amount of information become manageable for me. Then after that, I do then move to a more manual process of looking at some of the stocks in the spreadsheet results that are highly ranked and score well. And then I start looking at them manually and doing further research to think whether the numbers actually match up with the kind of story behind the situation and the things that can't be shown in the numbers, whether that's something that would fit into my portfolio or whether it maybe duplicates a company I already own, and whether it's something I might be interested in investing in. So it's a funnel really to bring it down to a manageable number of companies, and then I do more manual research and in-depth work myself.
Yeah, so there's quite a lot of research and time. How much time would you say you spend each month on this then?
I suppose quite a bit of time each month. I think if you're not willing to if you're not willing to put quite a few hours in each week, it's probably difficult to invest in shares effectively, because when you're dealing with just a handful of individual companies, you do need to have a certain level of understanding of the businesses and of how accounting works and how to read accounts and all this kind of thing. So yeah, there is a reasonable investment in time.
Yeah.
And I suppose I see that as something I quite like doing, that I do instead of paying someone else to do it ultimately.
So is dividend growth one of the metrics that you look for when you are doing your manual screening? And how important is dividend growth to you?
It's a really important thing for me, and it's one of the things that I've learned the hard way over the years, because at first there's an obvious temptation to be attracted to very high yields because you're getting all that bigger income, a bigger percentage return on your investment right up front straight away. But one of the things that sort of maybe took me longer to understand is the way that the growth of the dividend over time really represents the growth of the underlying business, I suppose. My approach now is based around the idea that if I can find businesses that can deliver sustainable dividend growth, then I don't really need to worry about the share prices, and I don't really need to worry about the long-term value of the investment. And the reason for this is if the dividend rises each year, then the share price over time is likely to rise too. And
Yeah.
if the dividend keeps on going up, then they'll be prepared to pay a little bit more for that in the future than they
Yeah.
will today. Kind of more broadly, if I see the dividend really as a signal of the state of the business, if it goes up each year and it stays sustainable, it's still covered by profits and so on, then it means to me the value of the business itself is probably increasing over time as well. And so, as
Yeah.
again, coming back to the share price, the shares also are probably going to be worth more in the future than they are today.
Yeah.
There's no certainty in any of this, but this is generally, I think, how the relationship works, which is why dividend growth is a really big deal for me, something I really look for in a stock, in a
Yeah.
potential investment.
When you're looking at dividend growth then, and you're looking at ever increasing dividends or a steady trend up, does the payout ratio play a factor into that for you then? Because what if the payout ratio is getting bigger, and is that a cause for concern?
Yeah, it is potentially. I think the payout ratio, as you say, just for anyone who's not familiar with it, the payout ratio is really just the amount of the company's profit that's paid out each year. So if a company's made a £10 million after tax profit and pays out 5 million in dividends, then that would be a 50% payout ratio. And so you can see the payout ratio gives you an idea of how much margin of safety there is. If I see that the payout ratio is rising and rising, then what it tells me is the company's paying out more and more of its profits as dividends, is keeping less behind to reinvest in future growth. And perhaps also by increasing the dividend in that way, what the company's trying to do is disguise the fact that their growth is slowing.
Yeah.
They keep on increasing the dividend, shareholders will be happy for a while. But if that payout ratio is getting bigger and bigger, then the safety of the dividend to me is suffering. And somewhere down the line, it maybe is more likely that the payout's going to be cut. And again, cutting the dividend payout is generally a signal that the underlying business isn't growing in the way I'd have hoped, or that something else has gone wrong. So yeah, the payout ratio is a useful metric and certainly an important one for me.
Yeah, that's fantastic. So we've looked at the buying side. So let's take a little deeper dive into your portfolio. How many stocks do you own? And have you ever experienced a significant loss in one of the stocks that you've purchased? And how did you deal with that?
So in general, I aim to have about 20 in my income portfolio, but it's not a fixed target. I suppose broadly speaking, I'd be comfortable with somewhere between 15 and 25. But for me, around 20 is the right balance between focusing on my best ideas, I hope, and also having some diversification to protect me against the unknown. Because it's always tempting to think after a while that you know everything about a company, but as an outside investor, you never ever know everything about a company, and it's always possible that you're going to be blindsided by something, however much careful research you do. So 20 is a good number for me. I think mathematically, if one of them loses 50% of its value, the loss for me is still something that I can live with and sleep at night. Have I experienced big losses in the past? Yeah, absolutely. From time to time, I suppose they generally fall into two categories. The times when something unforeseen has happened. And what I tend to do is just look at the situation, look at the information that's there and think, has the story changed? Do I really think this is going to come back? And when something badly goes off the rails, we're probably more likely to sell and then think about it and see how things go, because the first lot of bad news sometimes is followed by more bad news. Things like that happen occasionally, and I spend a lot of time trying to make sure that they don't happen too much to me. This is one of the reasons I go through such a filtering process, to try and look for all the kind of warning signs that might indicate something bad coming down the line. But I think what makes me more uncomfortable possibly is when I've gradually ignored the fact that something isn't going to plan, and it's more of a creeping problem that leaves me with a loss. And I lately have realized sometimes that this is not the investment I thought it was, and there's no kind of easy solution. I think it's tempting to think you might want to hold on and get back to where you started, but I try and never ever do that. If I feel that my conviction on an investment has gone and that I don't think the story matches up to what I originally paid for, then I generally will sell it immediately without really thinking about the price. And obviously it's no fun crystallizing a loss and losing money, but what I tend to find is that I actually feel better afterwards, because I've got out of a situation that had become a problem that was starting to be a worry and that could have got worse, and I'm able to move on and focus on more positive aspects of the portfolio.
Yeah, it's a challenging, isn't it? Admitting the loss and then taking the loss. It definitely...
Psychologically, it's difficult, but I think it's one of those times when it's important to be really honest and disciplined with yourself. If the story doesn't add up anymore in the way you thought it did, then if I think now I wouldn't buy this anymore, from what I know now and from what I can see now, then I would be quite likely to sell.
That's an interesting way of looking at it, that if the story doesn't match up to what you once thought, what you originally bought, then it's time to cut. You create a story around the company through all the different filtering processes, and then if that story doesn't match up, that's it. So over the last 18 months, we've seen a significant drop in the market. We've got high inflationary pressures, global instability, the war in Ukraine, things like that. How does that affect you when you're analysing your portfolio? Because you're specifically dividend growth investor. And you've probably seen some of your stocks drop significantly in the price.
Absolutely, yeah.
How do you handle that then? Or do you say the dividends are still looking good, profitability is still looking good, this is just an overall bear market as opposed to a specific problem with my company?
Yeah, that's exactly it, really. I think if the share price of one of my companies falls sharply and in isolation, then I will definitely spend some time trying to understand why and whether I need to be concerned. But when the whole market is falling to some extent or another, like we've seen over the last year, I don't generally worry about it too much. No one enjoys seeing the value of their portfolio fall, but I think I still own the same stakes in the same companies. And I think what we've seen over the last year reflects just wider concerns about the general global economy and problems, like you say, such as inflation. So over time, these factors may affect some of the businesses I own, but they're general issues, and I think they should pass with time. They don't alter the fundamental investment case. If I see any sign of a dividend cut, now that's quite a different situation, because as a general rule, companies don't cut their dividends unless they're forced to for some reason. So generally, it means already things are not going well. The dividend maybe has become unsustainable. And also, perhaps I've already missed some warning signs I should have seen sooner. If it's reached a point where the payout is cut, then it may be that I've missed some of the clues earlier down the line. So yeah, don't worry too much about falling share prices when the market is maybe in a bear market. But when one individual company is affected, I'm certainly more likely to pay close attention to the situation to see if it will affect the case for the dividends. Like you say, as the share prices have been falling, but dividends have been by and large being paid. So from my point of view, it's not been a particularly big concern.
Yeah, that's interesting. So you are semi-insulated from the broader market corrections because of the type of investing that you do. It insulates you from that broader market narrative of the world is ending, the crash is coming, isn't it?
It's that's another attraction really for me of dividends. If like you say, if the businesses are continuing to work, okay, the dividends are paid reliably, then I don't need to worry too much from 1 month.
What mainstream media is saying.
What people are saying or what the share prices are doing, really. If the share prices fall enough and the company's still performing well, then it's more of a buying opportunity than anything else, because a lower share price means a higher dividend yield. Yeah, it does provide that kind of insulation. It's a good way of putting it, and I quite like that.
Yeah, so this last 12 months has provided buying opportunities for you then.
Yeah, it certainly has at times, I think. I hope anyway. Ask me in a few years. No, it certainly feels like there've been some opportunities. But if you can just tell yourself that this is just a temporary phase, just like all the other things that have happened before, that they seem dramatic at the time, or they are dramatic at the time, and obviously serious problems at the time. But history tells us that these things come and go, and that the world keeps turning on a longer view. So that's what I try and That's kind of part of the discipline I try and maintain, not to react to things unnecessarily.
I've had quite a few conversations with investors over the past few months. One of the things that they say is important to them is AGMs. They find them a really good source of information about the companies that they own. Lord Lee of Trafford was a big advocate of them. Do you use AGMs as part of your screening, or do you attend AGMs?
I have to admit, I've never been to an AGM. I don't attend them. I suppose there are a couple of reasons for that. One, on a purely practical level, where I live, actually visiting an AGM would almost always require a full day out, and it might even be an overnight trip.
Mm,
And for me, it's not really practical and it's not really worth it. But I think the other thing is that I suppose a lot of my focus is about looking at the data, looking at the accounts and the documented facts, and not so much relying on my impression of the people involved. I suppose I'm not sure I trust myself necessarily to be always a good judge of what people say. Senior directors, kind of by nature of their job, are generally very good at selling the case for their business. And although I know certainly people like Lord Lee and to go and they ask detailed questions and they do gain a lot of insight from that, and I wouldn't try and take that away from anyone, but I'm not sure that would be a strength for me. I think there's a kind of halfway house, which I suppose I do increasingly take advantage of. But there's a lot more stuff that's online now. When you want company results are presented, they do results seminars online and other presentations about changes to the business and so on. And so I do quite regularly attend that sort of thing. That just is an hour here and there. Quite often you can watch them back later on anyway. So I find that as a good compromise way to get a bit more insight into the company and to the people who run it, but without the commitment of an AGM, which isn't really practical for everybody. They're generally during the working day and quite often in London. So
Well, it's quite interesting. It demonstrates that there's so many different ways to approach the world of investing, and you found a system and a style and a strategy that suits you and it fits your lifestyle. So it just goes to show that there is so many different approaches that people can take towards this.
and investors have a lot more choice now. Again, with technology, the amount of data that's online and the amount of the presentations and so on that are put online, especially since COVID, you do have a lot more choice and you can gain an insight without having to actually physically be in the room.
Yeah.
And even 10 years ago, that was probably much harder. So there's a lot of progress and change that makes it easier for private investors.
Do you look at the management of the companies that you're investing in?
Yeah, I don't want, having said I don't go to AGMs, I don't want to make it sound like I'm completely ignore management. Obviously, the people running the business are a big factor and they have a big opportunity to add value and to destroy value as well. And so I do certainly look at the management. Some of the companies I own have family management, found or are still run by the founders.
Yeah.
That sort of long-term oversight is generally, more often than not, I would see it as an attraction. People who have a big stake in the business themselves, who have a big shareholding in the business, they're more likely to be taking a long-term view. They may receive the bulk of their income from dividends from that company. So obviously their interests are quite well aligned with my own.
Yeah.
And so I do look at management and their general experience, how long they've been there. I suppose it's an attraction, but it's not the first thing I focus on. Management would be some way down the list later on in my research to flesh out my picture, to flesh out my understanding of the numbers. I'd look at some of the human elements as well.
Yeah.
Later on in the process. Yeah.
Yeah. So you've got your stock screening that brings you down to approximately 250. Then you've got a spreadsheet that narrows it down even further. And then you start looking at them individually, manually. And at that point, you probably would then start looking at the management and things like that. Would that be the general process? Yeah, understood. We've covered a lot on the buying side of things. You must sell stocks at some point. What has to change for you to think, right, time to sell? Or is there a point where a stock becomes too much of a large holding of your portfolio, a large percentage, and you have to trim it, you have to rebalance?
I think being a good seller I find it very difficult to know the right time to sell. And that's one of the reasons I think that I've developed the way my strategy is to not require many sales.
Yeah.
I think as a general rule, wouldn't sell a stock just because the price has gone up. Even if I think it started to look expensive, if I already own it, then I'm not paying that price. And if the business is still performing well and I believe the dividend will continue to grow at a decent rate, then I'll generally just continue to hold the shares. Where I'm more likely to consider selling is, as I was talking about earlier, where I think the story has changed. If I think that metrics, for instance, if I saw profitability getting steadily worse, or if the company wasn't generating cash in the way it did, if debt levels are going up, and maybe in danger of reaching a level that I thought would be uncomfortable. Things like that would make me think seriously about whether I wanted to sell.
Mm.
And also if the business itself has gone through a big change, is maybe made some very large acquisition or is trying to change its own strategy to do something different. Areas like that would make me think quite critically about whether I wanted to sell or not. But generally, I don't generally sell just because of share price movements. That would probably be one of the least likely reasons that I would sell.
Yeah. So your strategy is inbuilt for you to hold these long term. It's built into the strategy to hold these for a very long time, isn't it?
That's my goal. Yeah, I
Yeah.
try and see it as owning a portion of a business, because obviously all
We'll be
the
here in
companies.
20 years' time.
That's the hope. And
Beyond.
it's because it's on the stock market. You've got this liquidity. You can always see the share price. You can always buy and sell every working day of the week. But if it was a privately owned business, a small business that you owned yourself in your family or anything like that, you wouldn't have that visibility of what it'd be worth, and you wouldn't generally be thinking about buying and selling so readily. It wouldn't be practical, and it wouldn't necessarily be desirable. And I try and think of it in that sense, that I own a portion of this company, and if it's performing the way I want it to, there's no real reason to sell. I'm not trying to slice a profit off the shares and move on to the next thing. I want to try and find the things I think are the best businesses, and then hopefully just keep owning them for a long time, as if I was an owner rather than just an outside investor. It's not a perfect analogy, but I think that's the mindset I try and have. One area I suppose that could be a problem would be rebalancing. I don't generally rebalance positions that have got larger than others, but if a position, say, maybe got to be something like 20% of my whole portfolio, it's not necessarily likely. But if something like that happened, I'd have to think seriously about trimming it and selling a portion of it just to bring it down to a more manageable size, because as I said earlier, I would still be an outside investor in the business. I wouldn't have that insider insight as to what was happening.
Yeah.
There'd always be the risk that something unforeseen could go wrong. And if it had become such a large part of my portfolio, I would feel I probably needed to take steps to protect myself from things that I couldn't foresee. I would be kind of reluctant, but I would consider rebalancing in a fairly extreme situation.
It's a good headache to have that, though, isn't it? Because it means that a company has grown quite significantly. So
it would be a good problem to have.
It would be a good problem to have. Yeah.
It's not something I'd expect to happen very often, if at all.
Yeah. Are you a lone investor? Do you collaborate with other investors? Do you attend meetings or things like that? Or is it just, do you attend online groups, or is it just something that you quite happily?
Most of the time, I suppose I work alone. I have been to investor events once in a while, share groups and Mellow and so on. But as a general rule, I would say I invest alone. I don't generally discuss ideas all that much. I work with my system, and I try and read quite widely and take in information from elsewhere. But I'm very much focused on trying to follow my own approach. I think one of the things I've learned over the years is that you have to be very comfortable with your own approach. You have to understand why it works for you. But having said all of that, there's plenty of value in other people's opinions, and it's always good to question yourself against someone who has a different opinion and say, are they right? Are you right? And to check your logic. So yeah, there is value in
collaborating.
In collaborating and getting an outside perspective.
Yeah. As we come to the end of the podcast, just a few final questions, really. Just what would you say is your biggest investing mistake, and what can the audience learn from your mistake?
It's certainly in financial terms, the biggest mistake I've made really came from selling far too soon. I think a lot of people have similar stories, but one thing that relatively recently, when the kind of mining market crashed around 2015, 2016, and some of the big FTSE 100 miners like Anglo American and Rio Tinto, their share prices absolutely collapsed. The outlook, it did look a bit bad at the time, and they had quite a lot of debt, but I thought that things had gone too far, and I bought some of these shares, and I did manage to get to buy in really quite near the bottom. And the market, as it turned out, the mining market picked up a lot quicker than people expected, and I made a good amount of money on them, but I sold far too soon. If I had just sat tight for a few years, and even still to today, it would have been, it's definitely it's definitely the one that got away from me. It would have been a big success. But so I suppose what I learned from that is not to try and judge. I thought to myself I was being clever, and I thought, this is not going to get much better than this. This is as good as it's going to get. But I think really when things are going well and the trend is your friend, it's probably best just to keep going. If things are going well, then maybe don't question it too much. Certainly don't try and anticipate something going wrong when there's no real reason to think that it is. But these things happen, and it's one of the reasons I suppose my strategy has developed as it has, really, to stop me making too many decisions that are very subjective and based on guesswork. Try and avoid doing that so much.
I'm presuming that experience has helped improve your ability to hold on to these stocks longer than probably most would be able to. Would that be a fair comment? When you sell something too soon and you watch it do what you thought it might do, or perhaps maybe was anticipated, then the next time that happens, you're like, I've seen this before. I know. Just hold. It's okay. It's fine. We've been through this.
Yeah, I think it's like a lot of things in life. Having the experience of actually
Build the
seeing things play
experience.
out gives you a little bit of an advantage next time if you recognize. And I suppose in this case, it's again a psychological thing, is becoming anchored to what you paid for a stock. I was lucky enough to pay a low price, and then in my head, I was anchored to that low price. I was thinking, look how much it's gone up from there.
Yeah.
But actually, that was irrelevant. The low price was an anomaly, really,
Yeah.
and it wasn't what you would call a normal
Situation.
situation.
Yeah.
And when I sold, they were probably still relatively good value. Looked at over a long period, looked at through a whole cycle.
Yeah.
Even the prices I sold at were probably relatively cheap. It was just that I'd become fixated on the price I paid and how much it had gone up from there. And with hindsight, that wasn't really relevant at all.
Yeah.
The only thing that was relevant was, I suppose, the bigger picture, where the situation was at the time, and also looking at the wider historical context, say over 10 or 15 years, and understanding how these things come and go, rise and
Yeah.
fall.
So how do you avoid then the latest hot stock or hot market or hot sector, the new kid on the block? How do you avoid that type of narrative that is quite strong in the media?
I think one of the things I do to avoid being drawn in is that I avoid them altogether, really. Companies, I
You
mean,
wall yourself off from all that sort of.
obviously you come across interesting stories from time to time and you think,
Yeah.
wow, that could be a great story. All too often, the operative word is story rather than anything else. Things sound good, but they don't always work out that way. But what I find is that I have kind of background awareness of some of these hot sectors and hot stocks that are attracting a lot of interest, but they don't make it through my screening system. They don't get anywhere near the bottom of the funnel, as it were. So I don't generally seriously consider. Then
Yeah.
it stops me being distracted by things that don't fit within my strategy at all. And I think that's quite valuable for me because it saves you the risk of making investments that aren't consistent with what I'm trying to do.
That's really interesting. So they don't get through your screening system. That's it.
Yeah. In fairness, relying on a system like that does mean from time to time that I'll miss out on something that
Yeah.
that might well have fitted in, because with any system where you're relying on data, even with good quality data, there's going to be the odd anomaly or some kind of statistical glitch or whatever. And so it will arbitrarily be excluded. And I accept that there'll be a small percentage of things that I might have been interested in that don't make it through the funnel. But for me, the value that I get from having the screening system is worth it, is well worth that trade-off, because it's the only way I can manage a consistent approach that gives me most of what I'm looking for, I think.
Yeah. So last couple of questions then, and it's about mentors and the books that you read when you first started back in 2007, 2008 sort of period. Who was your mentors then, and what sort of books were you reading when you were just getting started in the investing journey?
I think when I started out, I came across some of the old investing forums and things like that and learning about stuff. I came across the same kind of classic book recommendations, things like Ben Graham, The Intelligent Investor, and some of Warren Buffett's work. I think one high profile sort of investor made a big difference to me a little bit further down the line was reading some of Terry Smith's work. Terry Smith is the fund manager who runs the Fundsmith business. Although I wouldn't go as far as he does with some of his focus on quality and being willing to buy stocks that appear to be quite expensive. One thing with him is I really gained an understanding of the links between profitability and growth and finding companies that have the potential to be better than average. And yeah, somewhere between Terry Smith and Warren Buffett, in terms of big high profile names, I learned a lot from both of them. In terms of actual personal mentors, not so much really, but I've come across other private investors over the years who have made me think about doing things differently. I think sometimes it's just you see how someone approaches a problem differently, and that makes you think critically about yourself, and that's been valuable.
Yeah, Roland, absolutely brilliant conversation there. Really appreciate your time. Where can the audience connect with you? Where can they follow you? Where's best for them to get to know more about your work? And I'll make sure the links are in the show notes so they can easily find you by scrolling down below.
Most of my writing about my portfolio and about the system I use is on my website, which is rolandhead.com. I tend to publish an article every week or two. They're quite long and in-depth. And there's also a newsletter that you can sign up for to receive the articles by email. And the other place where you can easily get hold of me is on Twitter. I'm at Roland Head. I'm not, I suppose, in keeping with my long-term approach, I wouldn't say I'm not a heavy social media user, but I'm there regularly and I try and put links to things that I've done and things that I found interesting to what other people have done too.
Brilliant.
So, thanks very much.
I'll make sure those links in the show notes, so please scroll down and follow Roland and sign up to his newsletter. Thank you very much for your time.
Thank you for having me.
Well, thank you for listening to the Fund Your Retirement podcast with Roland Head. I hope you enjoyed this episode, and if you did, please consider liking and subscribing and leaving us a review. Until next time, thank you very much, and I hope you have a great day.